All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Before we get started, want to just make a quick comment about tomorrow. Tomorrow morning, I will jump on video about 20 minutes early. I will wait until the 8:30 mark to make a trade, but I will have to hop off video right after that if there is a trade. If there's not a trade, I'll probably end it just a little sooner. But that's not a normal thing, and it won't be a normal thing. I don't share a whole lot about my personal life, but my wife right now is going through a medical issue, and we're not sure the severity of it. And so off for a scheduled test here tomorrow morning, and I need to go with her. So we'll be doing that. I'll be back in the afternoon for the normal time, and be along with you. It shouldn't affect any of the trade running or anything like that. Right now, we're not in any trades, and we do have a trigger here this afternoon, but it's one that kind of like FedEx yesterday. They have earnings on Thursday morning, so I'd literally have to get out tomorrow at the close if I got into the trade. Now the stock that's triggering here this morning or today is one that had a downside 3-7 crossover on it yesterday, and I mentioned it didn't trigger, and I was kind of surprised because the consolidation risk on it was pretty low. It's been consolidating now for quite some time, and that consolidation risk was fairly low. But it is snapped on back here today. Didn't trigger bearish yesterday. Snapped on back here today, and is triggering bullish here this afternoon. You'll notice the Stoke 39.1, well above 50 here. We have an upside 3-7 action going on here with Walgreens. But like I mentioned, they have earnings Thursday morning, so it's one where I could hold it. I could buy it this afternoon and sell it tomorrow afternoon. I did go look closely at the options. Walgreens is a stock that we've talked about a few times. I think has a major base out, happening with it right here, right now. And I think it's a stock that you could justify fundamentally up here in the $75 to $80 area. And it's one that I would like to be in. But when I go and I look at the options, they're not horrid. They're not terrible. The implied volatility, isn't crazy, especially on these 26th of Julys. And I could come grab the 52 and a halves for something like 250 here. But there's not a lot of open interest on them. The spreads are pretty good. The delta on them though is kind of where I decided no, I'm not going to bother. It's about a 50-cent delta on a $2.50 option, so about 20% there. If we look at the average true range, it's just over $1. So a 2 ATR move is a $2 move. So that would increase the option value by 40% on a 2 ATR move there. Yeah, we may get that tomorrow, but that's kind of best case scenario unless I hold the earnings. So just the reward element isn't all that high. Do I want to take the risk with that reward element? No, I really don't. So, it is a bullish trigger here this afternoon, but very much in that FedEx camp from yesterday with earnings on tap. Now, this is not going to be a very uncommon thing. We are going to see, stocks on the watch list trigger one way or the other ahead of earnings from time to time. That is not uncommon. In fact, it's something that's fairly usual. It is something where the performance of stocks after they've triggered on the algorithm, when it comes to earnings, the performance isn't all that different from stocks without earnings in terms of the whether it works or not, whether the signal plays out or not. What is very different is the risk parameter, right? Because one of the things that will happen is, you know what, it could get upside and great, carry on like an upside call would on the trigger. But most stocks that have a bullish signal do not have the risk of a serious flush in them. We do not see that happen very often. And when it does, generally you can get out. It moves that one average true range. Boom. Okay. Easy to get out ahead of the big drop or the time stop kicks in, like it did for us on J&J before J&J tanked. And so this is kind of a scenario where the downside element, which is has a few protections to it, so we don't see a lot of real big kind of trades go against us, and just where the option just goes to zero overnight. That element, that risk factor, increases dramatically when it comes to earnings. And, it also increases some of the reward potential on the upside. But, the option price, the way the options are, priced higher into earnings, means there's a greater loss bucket, a smaller reward bucket. And so while, yes, they perform at a similar rate, the risk factor and the performance of the options, it can be very much skewed. And so that's one of the reasons why I don't want to take that risk until we have, 10K in gains. Maybe on the absolute perfect scenario right here, I would. But, not going to go jump into Walgreens here on today's bullish signal. And so we'll continue to wait. I thought Chipotle had a shot at it triggering here this morning. It just hasn't materialized. We've seen Chipotle pretty much pull back all day here. It could still trigger, tomorrow or something like that. But as it sits right now, is not a trigger. Now we have a lot of downside 3-7 crossovers in the market right now, and this isn't anything new. We saw a lot of them yesterday. Very few, only FedEx triggering to the downside, right? And, here today we have CSX, Disney, Home Depot, MGM, Nike, Target, all on the watch list, all with downside 3-7 crossovers. Now, none of these are bearish triggers because most of these, they're coming off of highs, right? Target, it's coming off of a high up here. It's not something where this downside crossover is saying, wow, the probability of a downside trend is very high on this specific name. And whether we look at Nike, whether we look at MGM or CSX or Disney or Home Depot, the individual stock tells us that with the algorithm that, hey, consolidation risk is really high. But when we look at the number of stocks over the course of the last several days that have had downside 3-7 crossovers, it's very similar to the number of stocks that had upside 3-7 crossovers right back here. And that's kind of what we're seeing right now. We are seeing the number of crossovers be very high. Now, because we're coming off of a new high, because a lot of stocks are coming off of new highs, we're not getting a lot of downside signals. But it is something where the number of stocks moving or making this 3-7 crossover action does suggest some downside, some increased risk to the downside, and some elevated trend potential to the downside on the market itself. And so keep that in mind. That is something to be wary of, and something that what did we see in the news today? Well, we saw that U.S. President Trump and Chinese Premier, they're going to meet on Saturday. We saw Bullard from the Fed basically come out and say he doesn't think 0.5 basis point cut on interest rates is warranted, which the market is going to go, what are you smoking? Are you not seeing the same data we are? And in the Fed's defense, the data right now is very similar to the data in March, right? and the data in March, the market wasn't clamoring for a rate cut. The market was saying, oh, no, this data, it'll just improve. And the market just kept climbing up even with the data weakening. The data is no weaker right now than it was right back here. And it's just kind of one of those things where perceptions are different, right? Perceptions are a little bit different. We had the Fed Fed Chair Powell speak here as well. But when I went through the comments from both of them, there's really no change. There's really no change in what the Fed is saying. There's no change in their address and in how they're communicating here with it. So it's not something I'd look at and go, wow, this is a big change event, here with the Fed. But we are seeing the market sell it. Are they selling it because the meeting between President Trump and the Chinese premier isn't happening until a little later than they hoped? All those factors could come into play. But what's really interesting, to me, the most interesting factor here today, the S&P is down 24 points. Okay, great. All right, 24 points, 0.8%. Small caps, which lagged like crazy yesterday, they've been holding up. Now, they've given up about 50 cents here in the last 30 minutes, but, they've been outperforming the entire day, and they were the big laggard yesterday here in the market. If we take a look at something like the bullish percent index, you'll notice it's not pulling back today. Right? It's not really kind of creating any major change here. MarketVibe is in danger of going neutral by the end of the day. Where it sits right now, it is still bullish, but when it grabs its read here in the next 20 minutes, we may see it trigger into a neutral signal, but that's kind of right where it sits right here. With that. So anyway, that's where some of the stocks out there sit. Just some of my thoughts here. Walgreens upside trigger, in play here today. And, we have a lot of stocks with downside 3-7 crossovers, out there in the market. And it's the kind where, you take a look at something like a Microsoft, right? This isn't the first time Microsoft has done this, where from a new high, it has one of these days. And when you go back historically and you look at when it has one of these days, it almost always goes down further. Breaks the 7, from above the 7 on a sharp decline, kind of seemingly out of nowhere from a chart standpoint, this kind of outsized move. It almost always goes down. Now, sometimes the drop lasts a day or two and really doesn't fall all that much. Sometimes there's significantly greater downside there to it. But, if you go look at Microsoft over the last 3 years, this is not an unusual type of day for it. When it has these types of days, it tends to be followed with significant downside, to it, as far as, from the bear's best case scenario to worst case scenario is, okay, it just kind of hangs out and sits there. Adobe as well. These are some monster moves in these names. These are some very heavy sells in these names. You look at things like, like an Apple. It's not as heavy, not to the same degree, but that same action breaking below the 7. You look at a Twilio, one of the best out there. The 2-day move that it's had. These are big moves, right? These are very sizable moves, and very kind of moves indicative of further downside here to them. Now, unfortunately, they're not triggering on the algorithm. So something like an Amazon, which I'd like to go lower, doesn't have a downside 3-7 cross, and if it did, it may not even trigger simply because of where the Stoke 39.1 is. They're with it, but it's the type of price action that these stocks need in order to create a bear trigger later on, or to create a bull trigger later on. Because, all right, we get a little pullback. Amazon pulls back in the 1825 area. We get an upside swing, 3-7 crossover. We can play that up to 2,000, 2,100, right? Okay, sells off, rebounds back, very small, gets a secondary downside crossover. we could play that down into the 1700, 1600 area. So, these are some of the moves that we need to see happen to get signals in the future, especially with as kind of dry as, these crossovers have been in terms of being able to trigger signals. But there's no doubt that path of least resistance, given the price action we see today, is down in the short run. So keep that in mind here with things. We talked about Lennar earlier today, and after I got off video, I saw some of the commentary for it from the earnings call. Pretty ugly. And we talked about it, and Lennar was actually slightly green when we talked about it this morning. But basically, they lowered their earnings guidance going forward. Basically said their costs are going up, their sale prices are going down, and that basically equals a short seller's dream. And so, whether you're looking at KB Home, whether you're looking at Lennar, path of least resistance here, it's going to be to the downside, barring a major shift and a major change here in the fundamentals of the group and of the sector. So, keep that in mind there. Now, I was asked about gold and silver here today and any kind of plays on them right here. And full disclosure, I no longer have any play on gold and silver. I pulled my gold shares ahead of the Fed last week. Oops. And I missed the last week, last 4 days here on that. But I was fortunate enough to be in some AUY calls and some a GOLD call spread, both of which I have now pulled off. So I do not have any exposure in gold and silver at the moment. My bias remains strongly bullish on the group, strongly bullish on the individual stocks, and on the yellow stuff. Right, we've talked about it all year. That hasn't changed. You look at a monthly chart on gold. You go back and you look at this type of move on gold. It's typically followed with a move higher, but all too often we do get some dip come in after this type of move, where we're going to get a 3 to 4 week consolidation, pause, whatever you want to call it. It's still a group I'm very bullish on. I really like Barrick Gold a lot, and we take a look at GLD. I still like it a lot, but we start to put on some overbought, oversold indicators, right? The MFI's been overbought for a long time. Right, this kind of thrust into overbought, it's what should make you even more bullish on the sector going forward. But it's overbought now to a point where a pullback to 130 isn't necessarily bearish. Right, a pullback to 130, given the move that it has had, kind of a normal move. The normal moves, the way gold would move normally and come into retracement areas, has just gotten so far away that if I'm a buyer here and it doesn't continue to go parabolic and it has a normalized retracement, it's going to feel really bad. It's going to be very painful. And so, looking at it, I have a couple options, right? I can wait for it to have a normalized pullback, and that could start tomorrow. That could start after gold hits 160. And I simply, miss on out. And that's kind of where I'm at right now. I'm kind of just waiting, and if it keeps on going, I'll tip my cap to it and kind of move on and look at other stuff. But for me, this is something that needs that kind of 5, 6, 7 bad days in a row. Get people talking about this gold bubble and then start to see it turn back again. That's what I need to see personally to want to get in here to it. I've talked about this is a long-term breakout. This is not this is not something where we're talking about overbought, it has to go down. We are talking about a major long-term breakout here on the monthly chart. And, we saw this happen while we were in the GLD call position for the challenge. And there is nothing here to suggest that this is anything but the breakout. And long term, I think you could be looking at a $200 price target here on GLD. So how do you play it, right? That becomes one of the tricks here is how do you get involved? Looks like market's flushing a little bit more here, but if you come in, one way that I looked and said, you know what, maybe I go out and do this here with GLD is I take a look at a longer term call spread, right? So here we are with a monthly chart, looking at the 140, 150 area here on GLD. If I come into the Januaries, and I could buy the 138s and sell the 140s, something like that. I can even get a little bit more aggressive and come into something like the 140s and buy those and sell the 145s. So I'm able to get in for about $1.15. $1.15 there for something that has $5, potential being worth $5, more like $4 if I'm going to be, realistic about it. But I can get into something for $1 that can turn into $4 without gold having to make, that abnormal of a move. And so, I was looking at that here today. I decided not to put it on just yet. But one of the things that I can do if I put this position on is if it starts to go against me, when we get that normalized retracement, well, I could turn around and sell the calls or buy back the calls that I sold, pocket a small gain on those and hold the calls that I bought and let those go. Obviously, I would not have the same type of protection in that scenario, but that is, one of the ways that I was looking at it here today. I decided not to pull the trigger here just yet with that, but you can even go out further. You can either go out another year. And, you can come in, pay, hope it gets filled, and you may have to start creeping it up a little bit if it's not filled there, as you would like. The other way to play it is to say, look, I want to own gold. I'm willing to take a little bit of risk, but I don't, and hurt dramatically. Well, in that case, you could come into these deep in the money options. The 100 call you right away, leave it in there for a day, see what they do. And then you're able to kind of get into it with $37 at risk. If gold just, craters, it's going to sting, but you're in a nice position to really kind of take advantage of that over the next year and a half. And when we talk about gold and we talk about the uptrend in gold, I'm not talking about what happens to gold tomorrow. I refuse to play that game with gold because it can be so volatile. And you know what? Great. If GLD or GOLD trigger for the challenge, I'll go play it. Right? Like we've already seen this challenge, I'll go play it. But in terms of the long term of gold, there have been major factors that have shifted to change the entire sector to give it a bullish tone after 1, 2, 3, 4, 5, 6, 7 years of consolidation. The Fed is heading to zero interest rate and to more quantitative easing. And that's only going to push gold higher. That's only going to push it, similar to what we saw in 2009, 10, and 11. We're going to see these big moves. You'll notice, though, that there were some very hefty downward moves during that time as well. But the overall trend snaps. It's going to snap big. And I think what we've seen is just the beginning. It's just the beginning of it, from a longer-term perspective, right? From a longer-term perspective. But to see a $5 pullback in the next week and a half, that would actually... Now, a lot of times people will equate gold with silver, the reasons why we saw silver outperform gold so sharply here in 2010 is because we were starting to see economic pickup. We were starting to see, yes, the Fed was doing quantitative easing, but we were also seeing the data improve. and silver has a sizable industrial component to it. And one of the reasons why silver is lagging gold this month is because gold is not going up because of an economic impact, right? This isn't economy's getting better, gold go up, silver go up. We're seeing silver, yes, sympathy bounce, but it's not keeping up with gold, and it will not keep up with gold until we see the economic data improve. Until we see the Fed continue to lower rates while the economic data improves, gold's going to outperform silver. When we see the Fed continue to lower rates and to do QE programs while the economic data actually improves, silver's going to outperform gold. But as it sits right now, it's gold outperforms silver. I'd much rather own a silver miner than a gold miner than a silver miner, even though a lot of those are kind of together. But you look this month, 19% move for the GDX. That's outperforming gold. That's outperforming silver in a huge way. This is where you get the exposure. And we've talked about in past videos some of the higher risk names like an AUY. Right, and again, I pulled my calls off on it here this morning. But we have AUY, we have Harmony, HMY here, where you can get some really high risk, but let's face it, the risk factor isn't all that great, right? But you can get some monster reward. These are some $2 stocks that could easily go to $10 to $12 if we see that big move in gold continue. And they're sitting about $2 right now. And, okay, fine. You risk $2 for something to go to 10. Think of that as a very long-term option on the gold market with some very good risk reward and the probability in your favor. It's not like a lotto ticket because you do have the probability in your favor, unlike a lotto ticket. So AUY, Harmony, two ways I think are very, very interesting. As far as some of the silver miners go, you have Pan American Silver up 21% this month. If I'm going after silver, this is how I'm going after it. With Pan American Silver. But, I'm not really all that interested in silver. I'd much rather play gold. I think the upside's greater and the downside is less there with it. I'll be very curious to see what happens to silver when we see gold pull back. But I suspect, and I could be wrong, but I suspect that we will see silver lag gold, if both pull back. And that leads to kind of the last trade here that, I think is on the board with gold and silver. Forget about where they are right now. Go buy GLD. Go short SLV. That simple. Same dollar amount in each, but long GLD, short SLV. Basically, what are you going to do with that? You're playing for gold to outperform silver. You're not playing for one to go up and one to go down or anything like that. You're playing for gold to outperform silver. This is very similar to what we talked about with Triple M and Honeywell, right? Where right here after earnings, you short Triple M, right? You don't know if Triple M is going to go up or down, but you short Triple M and you long Honeywell. If the economy falls off and both go down, you expect Triple M to go down a lot more than Honeywell. If they both go up, you expect Honeywell to go up a lot more than Triple M. And what's happened? Yeah, Honeywell went up a little bit. Triple M went down a lot of bit. So you're long on Honeywell, made a little bit. You're short on Triple M, made a lot of bit, right? You're not always going to see that dynamic, but it's the same type of concept there with silver and gold. You get long gold, you get short silver, and you play for gold to outperform silver while the economic data continues to erode. And, you just switch that trade once the economic data starts to improve. And but that's a trade I expect to be on for the next 6 to 9 months. I don't think that's a trade where you go, well, okay, it's just going to work tomorrow. It's something that I would expect to kind of play out over about the next 6 to 9 months here. Okay. All right. So that's, some of my thoughts here on the market, some of the things going on out there, here today, and, some of what we're seeing in tech and here in gold and silver. I'm just pulling up S&P futures here to see if we saw a bottoming candle No, we haven't. Earlier today we saw a bottoming candle come in on Powell's speech, which suggests that it's going to be very difficult for the market to be able to close below this level. Now, we've gone below it, but we're snapping back up to it. I'd be very surprised to see the market close below 29.27 here, with it. But anyway, we'll kind of see how that plays out. All right. So no new challenge trade, bullish signal here on Walgreens, we'll but not able to trade it with earnings here on Thursday. Again, I will be back with you here tomorrow morning. I'll be on video about 20 minutes early and be wrapping up a little bit earlier than normal. Like I said at the beginning of the video, I do have to be away a little bit tomorrow morning as my wife gets some tests done that I need to be there to support her with. Thanks for hopping on. Have yourselves a fantastic evening, and we'll talk to you later. Take care.